Good afternoon and welcome to the Equifax Market Pulse webinar, where we're going to be talking to you about the Q1 2025 consumer credit trends. My name is Becky Oakes. I'm the Vice President of Analytics here at Equifax, and I'm joined today by Kathy Katsouleris, our VP of Consulting, and Swarnima Pandey, who is our Head of Insights. Before we get started, I'm just going to hand over to Jordan, who's going to talk to you a bit about the On24 platform and some of the things to look out for. Jordan.
Thank you so much, Becky, and good afternoon, everybody. For those of you who have joined us before, welcome back. For those joining for the first time, thanks for joining us today. I'm here to provide a brief overview of the platform you see in front of you. Now, each area within the On24 webinar platform is responsive so that you can maximize or minimize each widget or box on your screen based on your viewing needs. There is an Ask a Question widget underneath the media player, so feel free to enter any questions you may have, and we'll try to address them throughout the session today. In the event that there are too many questions to get through, we will reach out to you individually to follow up in the coming weeks. Today's presentation in English and French is available for download in the related content area, along with a lot more great material and links that you can click on. This session is being recorded. You will receive the on-demand link via email tomorrow. In the top right of your page, you will see a link to register for our Market Pulse Business Trends event next Thursday, the 12th. We've got such a great session lined up with lots to be shared and with a guest from the Business Development Bank of Canada, so do not miss out. Some additional features you'll notice on the bottom of your screen are reactions, so you can let us know how we're doing, thumbs up, laughs, whatever. Our survey, which is always open as well, and a contact us. Feel free to check any of these out and provide your feedback. We love to hear it. We appreciate it all. And with that, let's get started. Becky, back to you.
Thank you so much, Jordan. So as always, we're going to start with taking a look at what's going on in terms of the economy right now. So a little bit of good news when we look at things like inflation. So one of those key indicators that we look at on the economic side. Inflation levels end of April were down a little bit. They're below the 2% target rate at 1.7%. Now, the challenge is, though, when we start to dig into what's really causing that, that's primarily coming from lower energy costs. So we know there were some changes in terms of some of the federal pricing that was in place, and that's kind of changed this year in March. And that's one of the big drivers why that inflation level is below 2%. One of the challenges for a lot of consumers, though, is what's causing increases above that 2% threshold. So in particular, when we start to look at things like grocery inflation, specifically food purchased from stores, that is still sitting above that 2% at 3.8%. And that's been increasing for 3 months in a row. And that does create challenges, of course, as consumers look at their living costs and kind of their day-to-day expenses, things like grocery costs going up still. That is a big challenge for many. And particularly when we break down some of the elements of those food costs, things like fresh beef, meat, coffee, tea, they are going up 13.4%, 16.2%, really some big numbers coming in and kind of having a significant impact on some of the consumer side. If we also look in terms of what's happening with shelter, that has been something we've been monitoring for a long time on inflation because of the cost of funding and costs of financing, things like mortgages and rental prices. That is still up. So owned accommodation is up 3.5% and rental costs up a little bit over 5% year on year. So all of those things are still going to be contributing to a consumer's situation and therefore their ability to keep making payments on the credit side. Now, if we switch from inflation and start to think about employment levels, we were kind of towards the end of last year seeing a little bit of a improving situation. We saw the employment ratio in Canada rising towards the back end of last year, partly driven by population growth slowing down a little bit, but also just some positive movements in terms of lower interest rates, a bit more business investment. Now, of course, the last few months, however, have been a bit more challenging. We have a lot of economic uncertainty across Canada right now. Certain provinces being impacted more than others, certain industries being impacted more than others. And you'll see just on that right-hand side table, certain consumer demographics being impacted more than others. So unfortunately, that employment ratio is starting to fall again. You can see that on the left-hand side chart in red. And in particular, we're seeing unemployment levels really rising for under 25-year-olds. So we've actually seen about 120 BIP increase in their unemployment rates compared to 12 months ago. But unemployment is also rising on other areas as well, and some of the other age groups. It's just particularly challenging for those younger consumers. And if we start to see where that unemployment is really coming from, unfortunately, it is being impacted by this economic uncertainty period that we're going through. So manufacturing and wholesale and retail trade in particular, we're seeing employment levels really falling over the last few months. And particularly that's impacting regions like Ontario, where we have kind of a higher weighting of businesses that have been impacted by some of the changes that we're seeing on kind of tariffs and things like that. And there's a little bit of positive news in that we are seeing some employment growth in some other areas like public administration and some of the finance, insurance and real estate sectors. But again, kind of some of those shifts that we're seeing on manufacturing and retail trade, that's kind of overweighting it a little bit. When we start to look a little bit more detailed on the geographical side as well, regions like Windsor in Ontario, we've seen a 140 BIP increase in terms of their unemployment rate. It reached 10.7% in April. And this is really important as we start to look at the credit side of things, because unemployment levels rising is typically a shock factor. You know, once you kind of have consumers losing their jobs or maybe having their hours reduced, that can have a significant impact on payment behaviors. So that's kind of what's going on with inflation and employment side of things. I did mention population earlier. You know, we know that immigration numbers have been coming down. Kind of some of those targets have been reduced to try and really allow the country to kind of settle down and kind of let the infrastructure catch up a little bit with those rising population levels. What that does mean, though, is that we are continuing to see interprovincial movement. So areas like Alberta, it's down a little bit compared to last year, but we're seeing net movement increasing into Alberta and into areas like Nova Scotia, New Brunswick. And a lot of that is really coming from Ontario. The cost of living in terms of Ontario, you know, we're seeing some of those individuals kind of moving away and kind of into regions like Alberta. And then finally, just on the GDP side of things, we did see in the first quarter GDP per capita rising, which was some good news. Now, I guess the less good news is that a lot of that is actually coming from exports, which actually have probably been impacted by kind of the looming uncertainties in the economy right now. So we've seen a lot of movement happened in Q1, goods moving across the border in anticipation of some of the challenges that might be ahead of us. We also saw imports rising a little bit on that side as well. So yes, GDP is up. There's just a bit of a question mark in terms of how sustainable that's going to be for the rest of the year and whether we might see that story changing a little bit as we move through to the rest of the year. So that's kind of on the economy side. Just going to take a little bit of a deep dive now into what are the key trends that we're seeing across the consumer credit side of things. At a high level for Q1, there were kind of three main themes that we're going to be talking to you about today. First one is around credit card spending. We are finally starting to see credit card spending slow down, and we'll talk to you a bit about where that's coming from and kind of what we believe are the drivers behind that shift. When we look at the mortgage industry, probably no surprise here. New mortgages and kind of home movement is really down. We're seeing house sales are down, but we are seeing a lot of new mortgages coming from renewals and refinancing. So we'll talk to you about that renewal bubble that we're kind of experiencing and what that might mean when you look at some of your portfolios. And then finally, we're going to start talking to you, unfortunately, more and more about missed payments. There were some of our metrics when we look in particular at balance side of things where we're starting to see levels reach what we saw at the back end of 2009, which, as I'm sure most of you will remember, if you're old enough, that was the banking crisis. So we are seeing some of our figures starting to reach those levels, and we'll kind of go through where that's really coming from. But just to kick it off, when we look at overall consumer debt, it was sitting at $2.55 trillion at the end of Q1. That was up around 4%. Is up, but we are seeing actually some reduced demand for credit coming through. So when we start to look at it at a product level and look at some of the movements we would typically expect to see in the first quarter of the year, areas like cards, lines of credit, HELOCs, and on the mortgage side, we're seeing the shift in balance really is below what we would normally expect to see movement-wise. We are seeing auto loans in particular, though, more movement on those. So we are seeing some demand coming through on the auto loans, and we'll I think Swanham is going to share with you her thoughts on why that is happening and where that's coming from. When we look at this provincially in terms of non-mortgage debts, which is the right-hand chart, we do actually see differences across some of those provinces and some of the distribution of those debt levels. So areas, for example, like British Columbia, we tend to see some of the highest HELOC percentages, whereas areas like Alberta and the Prairies, kind of installment loans and auto loans tend to kind of really take kind of the lead in terms of what we see there. And the reason we kind of do like to call out some of the differences in terms of mix is, when we start to look at things like average non-mortgage debt per consumer, sometimes some of those provinces have higher levels just because they're using credit in a slightly different way. So Alberta, for example, tends to have a higher average non-mortgage debt per consumer, and some of that is really coming from things like those installment loans and auto loans and things like that. When we start to look at what's happening on that non-mortgage side and the change, though, compared to 12 months ago, we are seeing Ontario and BC and Quebec, they're really seeing the biggest increases in non-mortgage debt. And some of that is really coming from, there is some financial stress really quite strong in some of those areas, particularly in Ontario, which we'll kind of talk you through. And then on that right-hand side, if we take a look at what's happening in terms of a product standpoint, we are seeing products like revolving lines really, they've been quite flat in terms of non-mortgage debt per user, but we are seeing still increases on things like the installment loan side of things, and in particular on auto loans. So that's really where we're seeing the demand continuing to rise at the moment. Delinquency-wise, so I did touch on this. We are seeing non-mortgage delinquency rates when we look at the 90 plus, so that's 3 months or more of missed payments, and we look at the balance ratio. So this is the balance of those that have missed three payments or more divided by total balance. That's that left-hand chart. So you'll see here that sharp increase that we've been seeing for the last few quarters around non-mortgage delinquency rate. And you'll also see that orange dotted line just to kind of show where we're sitting historically. So again, back to almost the peak that we saw in Q1 of 2010 when the banking crisis was in full swing. That's kind of where we are on the balance side of things. If we look at volume, it's still rising. It's just not quite at the same level from a volume standpoint. So it's just where we are seeing missed payments come through. Those consumers are really carrying a lot more debt from a ratio standpoint than we would have seen historically. Right-hand side, just doing a bit of a breakdown on a product level. Almost all of the products are well above kind of pre-pandemic levels, with the exception of HELOCs in terms of missed payments and delinquency rates. You can see there, those little triangles tell you just how much they are above or kind of below those pre-pandemic levels. And we also added, because we've hit that interesting level on the left-hand chart around the banking crisis, just to kind of make it a bit easier for you, we've added in there how these compare right now to what we saw in 2009 from the banking crisis. So it's really cards and unsecured lines of credit where we're seeing that kind of variation and why we're kind of back to those levels, whereas auto loans and things and installment loans and HELOCs are still a little bit below. But it's certainly a concern to see those kind of levels of missed payments really starting to come through. In terms of consumer level, there was over 1.4 million consumers that missed a payment in Q1. That's up around 146,000 compared to 12 months ago. Now, we're seeing that really coming through from two different groups, really. If you are a mortgage holder, we're seeing a lot of increases still in Ontario and a little bit in BC, but Ontario by far is the worst of those two provinces, where missed payments on mortgages themselves and indeed the non-mortgage side for those mortgage holders are continuing to come through. Despite interest rates coming down, we're still seeing stress in there. And that therefore means, when we look at kind of demographics and age ranges, it's really the older consumers on the mortgage side where we're seeing those increases come through, just because they tend to be more homeowners on that age group. When we look at non-mortgage holders, it's really younger consumers under 35, where we're seeing those levels rising year on year in terms of consumer level delinquency. And again, Ontario, BC, Alberta, that's really where that's coming through. But again, so it's more younger consumers if you don't have a mortgage, and it's more Ontario and BC if you do. That's what's causing some of the increase in those missed payment levels. Okay, so before we take a quick break and see if there's any questions, quick look at insolvency levels. I mean, the good news on insolvency levels is that from a bankruptcy standpoint, we saw during the pandemic those levels really falling. They have stayed pretty flat. We still haven't seen an increase come through on those. We did see consumer proposal levels rising. They have come down a little bit, so a little bit of stabilization in terms of on the insolvency side of things. A little bit more good news is that the number or the percentage of surprise insolvencies. So this is where we see insolvencies coming through without any prior warning of missed payments and things like that. Those levels have dropped a little bit, so they're down to 37% in the first quarter. Now that is still quite a significant number. So yes, it's down from 40%, but you're still above 1 in 3, where it's very difficult to know this consumer is about to become insolvent. So definitely something to look at in terms of how you are identifying potential risk in your portfolio of upcoming insolvency levels. When we look at the balance side, though, of insolvencies, we're actually at an all-time high as well. So we're seeing those average dollar amounts at $49,500, and it's a 10% increase year on year. So insolvency levels maybe not as high as they once have been, but still playing quite a significant role. So I'm just going to take a brief pause there before I hand over to Swanima and see what's going on in the mortgage side of things. Just wondering if there's any questions that have come through.
Yes, there's one very interesting question that came through. So with delinquencies reaching 2009 levels, do we think we are heading to a recession?
Great question. So I was actually in a conversation with our little in-house economist, Bill Johnson, the other day. His view is actually there is a reasonable risk of a mild recession for the rest of 2025, probably seeing that turn the corner towards the end of the year and an improving position in 2026. Now, of course, we do have a lot of uncertainty in what's going to happen with things like tariffs and kind of will we get back to changes in kind of the import and export situation. So that's the outlook right now from our standpoint, is there is a reasonable chance of a mild recession coming through. But again, we have to kind of watch out and see what's happening in terms of some of those potential uncertainties. Okay, well, in that case, Swanima, maybe I can hand over to you and you can tell us what's happening on mortgage.
Yeah, sure. Thanks, Becky. Okay, let's start with a quick overview of the mortgage market. New originations are ticking up, but overall growth has still been slow. What's interesting is that the average loan amount for new origination is starting to climb back up again. This suggests rate cuts are making an impact, but not enough to fuel a buying frenzy. At the same time, we are seeing more people falling behind on their payments. So we are dealing with both cautious optimism and growing stress. We'll break this down further in the next few slides. Okay, when we look at our new originations, we are tracking first-time home buyers, renewal, refinances, and repeat purchases. This quarter, we saw a noticeable jump in new originations compared to Q1 of last year, which, as you can see on the chart, was the lowest point in the recent years. Now, part of that recovery was a solid 40% increase in first-time home buyer originations. It sounds impressive, but despite the jump, the absolute number of first-time home buyers is still among the lowest we have seen in recent times. And the share of first-time home buyers has actually been on the steady decline from 25% pre-pandemic to just 18% in 2025. So the market is shifting. Home sales remain low. Properties are on the market for a longer time. But prices have not really budged in some of the regions. In fact, average loan amount for first-time home buyers is now up by $30,000 when compared to first-time home buyers last year. And even though their monthly payments have dropped by $200 thanks to the rate cuts, this mismatch likely has many would-be buyers waiting it out, hoping for prices and rates to fall further down. So what really pushed originations up was the wave of renewals and refinances. They almost doubled from last year. And that's no surprise. Many of those 2020 ultra low rate loans are now hitting their renewal rates, and consumers are coming back into a very different rate environment. And here's where things get interesting. We are seeing more switching between lenders than before. There's a major shift in consumer behavior when it comes to mortgage renewals and refinances. Nearly 28% of consumers renewing or refinancing in Q1 2025 switched lenders. To put that in perspective, this figure was around 23% in 2019, so that's quite noticeable increase in switching lenders. This trend was visible across the board, but the highest lender switching behavior was from Ontario and British Columbia. And in these provinces, we know over 30% of consumers chose a different lender at renewals or refinance. So it's not surprising, given the borrowers in these regions tend to carry higher value mortgages and therefore are more rate sensitive. And every percentage points counts when it comes to your managed monthly payments. What we are really seeing is rate hunting. So consumers are motivated to reduce their monthly payments, and switching lender has become a tool to do that. In fact, high percentage of those who switched up lenders during renewals or refinance saw their scheduled monthly payment drop down than those who didn't. So this rising willingness to shop around is putting pressure on lenders and is ramping up competition. We are looking at one of the most competitive renewal environments because, and interestingly, 46% of lender switching is happening within big five banks themselves. So it's not just smaller lender poaching market share, it's also internal competition. Now, the not so great news, delinquency rates are climbing up. And it's not just a small tick. We have seen a good jump in delinquency rates. They have surpassed not only pre-pandemic levels, but they are now sitting at levels that were not seen since 2017. And what's driving this rise is the most vulnerable loans right now are those that originated during the ultra low interest rate window between 2020 and 2022. So many of these borrowers, especially those locked in variable rate mortgages, when the rates were historically low. But as rates spiked through 2023 and 2024, their monthly payments also surged. And for many, it's become too much to manage. On the other end, we also need to consider that those who renewed during the peak rate in 2024, those borrowers who may have originally had a comfortable fixed rate but were suddenly faced with a much higher renewal rates last year. Now that jump in scheduled payment is likely contributing to the rising stress. And our vintage delinquency analysis really brings that into focus. Like loans originated last 2 to 3 years are missing payments now at a faster rate than the earlier vintages. And that's an important signal it tells us that consumers are increasingly experiencing payment shock much sooner than what they have in the past. So even though rates are beginning to ease, the impact of the rate drops we'll see much later because the recovery won't be immediate. So let's now look at which regions are the hardest hit. It's the regional story. The delinquencies are not spread evenly across the country. Ontario and British Columbia are leading the charge when it comes to rising delinquencies. And these provinces with the highest home prices had the highest home prices, and that means bigger mortgages, and with interest rate spikes, the payment shock is a lot harder. And what's particularly concerning is the delinquency rates are rising faster for loan amounts that were over 500,000. And in Ontario and BC, that's more than 15% of the mortgage that fall in that high balance category. In contrast, for the rest of the country, that figure is just 4%. So the good news is most of the other provinces are below the pre-pandemic delinquency levels, which suggests a more stable footing because Ontario and BC are such large markets, their struggles are weighing heavily on the national average. So what we are seeing is a mortgage market that's adjusting to lower interest rate, but many consumers are still feeling stretched, especially those in the most expensive region. Now, Kathy, I'll hand it over to you to unpack what all this means for the lenders.
Awesome. So thanks, Swarnima. So before I do, I just want to quickly recap what we just heard about the mortgage industry. So we've got growth really coming primarily from the renewals and the refinancing, and a bit of activity from the first-time home buyers who are slowly coming off the sidelines. We do see that, consumers are really navigating the renewal environment, looking for those best rates to really minimize that payment shock, which is why we've seen that surge in the switching behaviors. And lastly, the D word, right? Delinquency. We've really seen a big impact on Ontario and BC because of more expensive housing, which translates into higher mortgage amounts. So putting this into perspective and taking a quick step back, we've got over 1 million mortgages that are expected to renew this year and next year. So based on the trends that we did see in Q1, we are expecting more switching to continue because, again, consumers are really rate sensitive and they're trying to get that best possible rate to limit their payment obligation. And we do expect to see more delinquencies after that lag delay from the impact of the higher interest rates, which means financial stress mounting to a point where we're going to see missed payments come through, which is going to then turn into delinquencies. And, we can't forget that we're in this environment right now that is really riddled with this economic uncertainty. You got high cost of living and that increasingly softer labor market. So if you've joined us before, you've probably heard me ask the question that if you're a lender in this space, what should you be thinking about and what should you be doing? So for starters, retention, or in other words, or the way I like to position it is playing defense, protect your share. We saw and we expect more switching is going to happen. So this is why it's going to be very important to get ahead of this by identifying who are the potential switchers and to do some proactive outreach to them with competitive rates to really secure that renewal and get that win. You may be now asking, okay, well, how do I identify who's going to actually switch? Which is a great opportunity for me to share how at Equifax we've really been supporting lenders using our latest innovative score called the Mortgage Attrition Predictor that allows you to really score the consumers and then rank order them to see, okay, who's more likely to switch so that you can then hone in and focus in on that particular segment and then tailor your strategy, give them a competitive offer, and then retain them. Think of it as really the mortgage attrition predictor being your little crystal ball or a way to anticipate the play so that you can make that defensive interception. A little sports analogy for anybody that's a sports fan. Anyways, on the first-time home buyer front, we did see some activity, and we do expect to see more, which means new originations will start to come back. So be sure, again, your targeted marketing efforts speak to attracting this segment so that you can seize the opportunity for some growth as well. And lastly, just the last thing I want to comment on is that D word that I mentioned. We do expect delinquencies are going to continue, especially in the hot spots like Ontario and BC, which means super critical to understand your customers and what their overall financial situation looks like. You got to look at their latest credit information to understand how are they managing debt. Are their payment amounts on unsecured credit changing? What's the cash flow situation? Use tools like the Risk Capacity Index. We talked a little bit about insolvency and bankruptcies rising. Use tools like the Bankruptcy Navigator Index. All of these are the different credit variables that you need to be looking at and leveraging on a regular basis to understand which segments, again, in your book are more at risk so that you can take the necessary mitigation steps. Okay, unpacked a lot there. So I'm going to park it right there and I'm going to ask that we move away from mortgages and tap right into what's been happening with the card market. So back over to you, Swarnima.
Thanks, Kathy. Okay, let's head to credit cards. So if 2022 and 2023 were the years of explosive credit growth, 2025 is where things are starting to cool off. New card originations are down, but balances are still rising. And also utilization is not climbing because lenders are increasing credit limits on new cards. The big red flag again for credit cards as well is delinquencies. They are trending up and are now higher than pre-pandemic levels. So while there's some resilience in consumer behavior, there's also rising pressure. Let's first dive into what's driving credit card balances. New origination, like I said, is down across the board, except in one segment, which is the lower score consumers. It suggests that some people may be leaning more on credit to get by, possibly due to the high cost of essentials or drained savings. Another factor in lowered originations is slowdown in immigration. So slower inflow means fewer new to credit consumers, which has weighed down on the overall origination growth, that also impacting the overall balance. Now, even though we had fewer cards issued, the total credit card balance have been climbing up just at a slower pace than what we have seen in previous years. What's interesting is the shift in how people are using their cards. We are seeing more transactor balance, so people who pay off their balance in full. That's a positive sign for credit management, but there's a flip side. While revolving balances have declined, delinquent balance has picked up. So it looks like consumers aren't just revolving anymore, they are missing payments entirely. So we are seeing a growing divide with some Canadians managing their credit well, while other consumers are clearly under financial stress. So let's move on to the next slide, which discusses credit card spending. So spending on credit card has dropped to a 3-year low. If you look at the first quarter, especially March spending, many consumers are pulling back on spending, maybe due to tightening budget out of necessity or facing persistent cost of living pressure, and as well as the future economic uncertainties. The biggest drop in credit card spending we have seen in Ontario and BC, reflecting the high cost and the inflation hitting those regions the hardest. When we look at age groups, older consumers show the most significant pullback in spending. This could reflect fixed incomes, more cautious financial behaviors, and less reliance on credit card for day-to-day expenses. Younger consumer, in contrast, seem to be in a tougher spot. So their spending hasn't fallen as much because much of it could be out of necessity driven. Think groceries, rent, transit, things they can't easily cut back on. So overall, this paints a picture of a market under strain and with varying impact depending on demographic or geography. Now, spending behavior has also impacted minimum payment trends. If we look through the generational lens, it looks like the younger adults, especially those under 35, Gen Zs and millennials, are increasingly making only minimum payments on their cards. So this is often a red flag, as it suggests they might be feeling the financial pressure and are just managing to keep their account current without making any real progress in reducing their balance. In contrast, for the older consumer, the minimum slightly lower, they're in a slightly better financial position, and they're more likely to pay off their balance in full and avoid the interest rate charges. And that shows the financial stress is slightly lower for older consumers than younger adults. And this divide, it also highlights the uneven impact of the economic pressure on younger consumer, potentially carrying more risks than older cohorts. And if you look at consumers that were under 26 segment, they stand out to be more vulnerable because their spend to payment ratio is over 1. That means they are spending more on their credit card each month than they are paying off. And if this pattern continues, it compound the risk, increase the debt, and eventually lead to delinquency down the line. And our data confirms the risk we have been seeing in earlier slides. So younger cardholders, especially those under 35, are experiencing the steepest increase in delinquency rates, rising much faster than the other age groups. So this trend is a strong signal of the financial stress that's hitting them. And unlike mortgages, delinquency levels for credit card is up across all provinces. And the stress is more visible for consumers who do not have a mortgage. Another important pattern in cards is that cards opened in the last few years are defaulting sooner compared to older accounts. So during the pandemic, deferrals, government relief payments, flexible credit options gave consumers a lot of room for breathing. But now, as those supports have ended, the cracks are more visible. The financial buffer that people had is now disappearing. But the debt continues to rise. So this is creating a challenging environment for many borrowers, especially younger, newer cardholders, are at a greater risk of falling behind on payments. So while the overall credit market seems resilient on the surface, these are the early signs, and it shows vulnerable population. Now I'll pass it to Kathy to discuss what this means for consumers and lenders.
Wonderful.
What do
So
you
thanks, Joanna. So again, just really quickly at a high level, based on what we heard, is really we've got a softer card market where more riskier consumers are applying for new credit. Those with credit cards are actually pulling back and being prudent on using them. And lastly, the biggest impact is that the pay rates have actually gone down for many. So less pay with interest on top is really causing the debt levels to increase. And the biggest segment that really is at the center of this is the younger population. They're missing payments and really contributing to driving those delinquency rates up. So putting this into perspective, we do expect that debt accumulation is going to continue to rise because of the pay rates and the missed payments. And remember, consumer behavior is directly correlated to the environment. And the environment today is creating a lot of financial strain and stress on many. So having said that, if you're a lender in this space, what should you be thinking about or what should you be doing in terms of managing your business? So first off, key area of focus should be really honing in on the customer segments that are experiencing stress and really monitoring them very closely. You got different age cohorts, you got regional splits. Both are important behaviors both are important characteristics that lead to behaviors because of where you live and how old you are. So look for early warning signs like the pay rate changes that we've just heard about. And any movement from being a transactor where you're paying off your card in full to being a revolver where you're making just partial payments. Look at utilization. Look at things like, are more minimum payments being made? Are there missed payments? What's the cash flow situation look like? Again, all of this, they're key attributes that really indicate whether or not the consumer is experiencing financial stress, so that again, you can get ahead of mitigating it, making sure you're mitigating any significant losses so that you also don't have a downstream collections issue. Next thing I just want to call out is that, as this financial stress really continues, there's going to be many high-risk consumers that may look to get new credit as a way to stay afloat, which is a slippery slope for many because it's going to just lead to more debt if the credit is approved. So oftentimes, what is more beneficial to these types of consumers are really resources to support them with financial literacy and tips on responsibly managing credit. So as a lender, it's really important to really promote and advocate financial literacy and have resources available to your customers to help them build up that confidence to have that financial stability. So on that note, I'm going to put a pin in this conversation. And I think it's time we rev things up with some auto talk.
Thanks, Kathy. Let's finally talk auto. So this was the bright spot in 2024, strong originations, robust demand. Consumers are borrowing more despite high car prices. But underneath all that growth, delinquency rates have been quietly rising up. So let's start by looking into new originations first. So auto new originations was up across the board. However, we are seeing some divergence in lender behavior. When we look at non-bank and captive lender, they seem to be holding steady with their prime borrower strategy. So likely a response to the delinquency spikes they experienced in previous quarters. But if you look at bank loans, they're taking a different route. There's a noticeable surge in new originations for bank auto loans. And it's what stands out is that growth is coming from all risk segments. So the shift could reflect strategic effort to capture more market. However, the share of prime borrowers for bank loans has not changed. Over 90% of newly booked loans are still prime. So this suggests banks may be balancing risks as they expand. Another trend worth noting is the resurgence of leasing activity. Leasing has been gaining traction since 2024 and after several quarters of decline. And at the same time, we are seeing strong originations for both new and car loans, pointing to a rebound in the consumer demand. So what's driving this demand? Likely a combination of interest rates, improved affordability for used cars, and the fear of future price hikes in the auto market. So for many consumers, locking in a deal right now feels safer than waiting riskier, higher costs down the line. We are also starting to see some normalization in loan structure, especially for a new car. So for new car, zero interest financing offers are back. The we did not see that back in 2023 or 2022, but now as the rates have gone down, zero interest financing for new cars is back up. And that's a clear sign that rate cuts and improved financing conditions are beginning to ripple through the market. But that doesn't mean affordability has fully recovered, because even though we see the shift in interest rates, loan terms haven't shortened that much, but we do see some shift for new cars. But because the car prices are still high. So while consumers may be getting a break on their monthly interest payments, they are still facing longer amortization to manage those payments. And the story is very similar for used cars. Rates have somewhat eased there too, but again, we're not seeing major shift in loan duration, and price stickiness remains an issue. Used car prices have dropped, but not dropped as much as people expected. So in summary, we are seeing some early signs of rate relief filtering through, but high vehicle prices are still keeping loan structures stretched. So now let's talk about risk for auto. So delinquency picture is a little more complex for auto. We are still seeing delinquencies rise, especially for used car loans. And that's not too surprising, because used car loans normally come with higher interest rates. However, there has been some stabilization among non-bank lenders, and that seemed to be the result of that strategic pullback towards prime borrower, less riskier borrower. And after earlier delinquency spikes, these lenders might have, and that's helping them stabilize that delinquency rate. But the real surprise is the new car loan delinquencies, which traditionally is much lower than used cars, but they have now surpassed the 2019 levels. This suggests that financial stress is spreading beyond the subprime and non-traditional lending space. It's affecting borrowers who under normal conditions wouldn't raise red flags. And once again, younger consumers are more exposed. The same demographic that benefited during the pandemic with deferrals and stimulus is now showing the fastest rise in delinquency across auto loans. So many of these borrowers likely took on loan during the peak vehicle prices, and maybe now underwater on their loans and owing more on the vehicle than it's worth. And our vintage analysis confirms this used car trend. So loans that originated from 2021 onwards, especially those issued in 2022 and early 2023, are showing fast deterioration. And these were vintages marked by a peak vehicle prices, elevated interest rates, and for many borrowers, longer than usual terms. And that combination has proven unsustainable. Borrowers are struggling to keep up with payments on assets that may already be depreciating faster than their loans are amortizing. So now when we look at new car loans, things appear more stable, but we are starting to see early signs of trouble there as well, particularly in loans that originated in 2024. And that's notable because borrowers likely entered the market after interest rates peaked and now are struggling to make payments. So it suggests that even with recent improvements in borrowing conditions, the affordability challenges are still there. So the auto market may look strong on the surface, but we are seeing cracks appear. We are seeing delinquencies rise, especially for used car borrowers, younger consumers, and recent vintages. All right, that wraps up our deep dive in the auto segment. Kathy, I'll hand it over to you for a summary of what this means for the road ahead.
Awesome. So thanks, Pranima. So really quickly, high level, we saw some really fast and furious activity in terms of growth, with many consumers really racing out to get that new auto loan before the anticipated price hikes went into play. So in terms of current and emerging trends to be watching out for, we do see that the younger consumers we're struggling to keep up with these new auto loans and really leading the charge with regards to the delinquency rate increases. Additionally, as you just mentioned, when we compared the vintages of new versus used vehicles from the pandemic period, we're actually seeing that many who bought during this time when we had the supply chain issues and prices were high, which then sort of also rolled into driving the prices of used cars up. Well, these cohort of customers that bought the used, they're actually the ones that are responsible for many of the missed payments that we're now seeing. So coming back to the question again, if you're a lender in the auto space, what should you be thinking about, or what should you be doing? So I'm going to call out two key things that I really want to touch on. First one being segmentation, right? Your customer base varies by characteristics like age cohorts, regions, credit profiles, and even the vintage period, that, you know, the time when they actually bought. And as well as the vehicle type. Did they buy new or did they buy used? So using segmentation, this is where you really need to carve out the pockets of consumers that are more risky and have really solid account management processes like a trigger solution in place that's going to monitor activity and alert you in a very timely manner so that you can, again, mitigate quickly to minimize your losses. So another way to make that interception. Second thing I want to touch on is, again, the environment, you know, where consumer demand may continue to spike with new auto loans being originated. And it really comes down to sort of two reasons behind this, if we're going to see that spike of more originations happening. First, that where a consumer now takes advantage of a lower interest rate and gets out of a current loan that had a much higher interest rate. And as a lender, you need to get ahead of this, right? Again, target those customers who may exercise this option, or offer them a more appealing offer. Don't let them leave and go elsewhere, but really sort of find a way to retain them. Or the second reason, again, in terms of why we're going to see sort of an increase, is because, you know, again, consumers might continue to rush out to lock in that purchase before any additional price hikes go into effect, not realizing that there's going to be a monthly ongoing obligation that needs to be paid. And, you know, you need to ensure that that consumer has the cash flow to carry this loan. So it's really important that your upfront strategies look at additional actions like the cash flow through the risk capacity index that I mentioned as well earlier, along with really sound account management processes that check in on that financial position of the consumer, so that, you know, it allows you to get ahead of making sure, again, you're mitigating any type of delinquency or, again, downstream collections issues. You don't want a collections problem. You want to be able to sort of, again, intercept early if possible. So enough on the auto talk. I am going to let Becky jump back into the driver's seat now, and I think Sarah's into some Q&A questions.
Thank you so much, Kathy. Yes, so a few of these questions I can maybe help with. So we had a question around, do we have a slide showing average credit scores for British Columbia and Ontario? Now, we don't have one in the deck, unfortunately, to share with you. What I can tell you, though, is that across the board, average scores have been coming down a little bit. Now, it actually takes quite a lot of movement to get average scores to shift. So as we do start to see them coming down, that can mean quite a significant impact to kind of a small group of consumers. Ontario is coming down the most at the moment. And I think almost all of the other provinces are seeing a drop, with the exception of some of the Atlantic provinces where actually they've gone up a little bit. So a little bit more positive on that side of things. We did have a question around mortgage fraud and what's happening with mortgage fraud levels. I don't know, Swanam, if you want to take that one.
Yeah, sure. So mortgage application fraud, we saw them rise drastically in 2022 and 2020. Now we are seeing applications come in. We are seeing the mortgage fraud rise up again for 2025. And normally the kind of fraud we see for mortgage is usually wrong information on their credit application. So they're either providing conflicting information or providing false bank accounts, false statements, false income information, all that to show that they can afford a much bigger mortgage.
Okay, fantastic. I think you broke up a little bit during that. So I think you said 2022, 2023, it was going up and kind of got to a peak. It had come down, but we're maybe seeing it turn around again and rise again. Okay, all right, fantastic. Thank you. Let's see what other questions we have coming through. I think there's a question around auto delinquencies on subprime borrowers. So maybe if I can start, and maybe Swanam, if there's anything else to add to that. When we look at subprime borrowers and look at some of the vintages in particular, the 2024 vintage has been particularly bad for early delinquency coming through on the auto side, much more than higher scores. So the subprime is definitely much, much weaker for kind of the last last sort of 18 months of vintages. I don't know, Swanman, would you add anything to that?
Yeah, sure. So yes, we do see higher delinquencies for subprime consumers, especially for used cars and now even for new cars. And we are seeing, while delinquencies are up everywhere, it's the subprime borrowers that we see the highest increase in delinquency levels.
Okay. And then, Swanam, again, sorry to put you on the spot. Any thoughts on auto finance fraud?
Yes, so auto application fraud has been on the rise in the last 2 years. We have just seen it increase year over year. And interesting thing is, normally for secured lending, we don't see identity fraud. But for auto, in the last 1 or 2 years, we have been seeing an increasing proportion of identity fraud, which normally is not common for secured lending applications. So we are seeing more and more people commit identity fraud for auto. Still fraud on their application, but identity fraud is a very concerning trend for auto right now.
Yeah, and I think the other thing on the auto side of things, it gets a little bit linked to that. Something that we've been actively working on is looking at things like loan stacking. So where you see multiple loans coming through in a very, very short period of time, that often can be quite a strong indication of fraud that's occurring. So if you are interested in finding out more about that, you can reach out to us directly and we can talk to you more about that. Let me see, any other questions? I know there's a question around general delinquencies and where we see those coming through. So just to kind of recap if you missed it, primarily in terms of missed payments, it's really if you are a homeowner, if you have a mortgage, it's really those individuals who are in Ontario, BC, the areas that had kind of the higher mortgage amounts, more impacted by interest rates and things like that. If you are non-homeowner or you don't have a mortgage, it tends to be more the younger consumers where we're seeing employment levels really starting to rise. We're seeing cost of living, things like that, really impacting that kind of group. Trying to see if there's any other questions we can answer quickly before I know we're about to run out of time. There was a question around surprise insolvencies and any key drivers, indications of do we have any data as to what is driving such a high surprise insolvency? I mean that's a great question. I mean, in a lot of cases, what you will see with many consumers, they really, insolvency is absolutely a last resort, and so there will be a lot where possible, individuals will try their best to not miss any payments because they know that impacts things like their credit file and their credit score, and they'll kind of move money around between different types of credit to maybe keep making payments. And then eventually, they'll reach a point where they decide to take the leap and go insolvent. Now, in particular, we see that on the consumer proposal side, and often that's kind of homeowners and people like that are kind of they kind of have those secured assets they want to protect, and so they'll kind of get up to a point in time, realize they're at a breaking point, and then at that point maybe go insolvent all of a sudden. But there is kind of different drivers linked to that, and one of the solutions we actually have is tailored more for what's happening economically right now. So we have a surprise insolvency index that is really trying to pull out and identify where those hotspots of surprise insolvency. So again, if you're interested in that, reach out to Kathy or kind of the team, and we can talk to you a bit more about that. So I know we have some more questions coming through. We've only got a couple of minutes left. So if we didn't get to your question, we absolutely will try our best to follow up with you afterwards in a Q&A document. But I did just want to take a few seconds to just, I know Jordan mentioned it at the start, just reshare about our business credit trends that's coming up on June 12th at 1 p.m. Sinead and Jeff from our commercial teams here at Equifax are going to be presenting that. And we also have Arno Franco from BDC. So Equifax and BDC, we have a joint small business index, a health index that we created a couple of quarters ago. They're going to be providing some updates in terms of what is that telling us around the small business side of things right now. And obviously we'll go through some of those key trends. And right now, it really is a difficult time for a lot of small businesses out there. So definitely worthwhile joining that, finding out what's happening, because it does directly link to consumers, because a lot of small business owners are just, the consumer population. Apart from that, I just want to say thank you on behalf of Swanama and Kathy and myself. We love having you join us. We hope this has been informative and useful for you. and we will hopefully see you for our Q2 trends in a few months. Thank you so much.